thank you all for being here. I'm honored to share the stage today with three of the titans of the industry when it comes to strategic asset allocation and long-term investing. We have so much to talk about. Just a week ago, we saw the US election and Trump victory. We saw another rate cut in the US. But we are sitting here today in front of a room of alternative investment managers and investors. So why don't we start with just each of you sharing a little bit about the makeup of your portfolio, particularly how you're thinking about alternatives looking at the year ahead.
Hi. Okay. I'm Yoshi Kiguchi. I'm CIO of Pension Fund of Japanese Corporations. So currently I am as a CIO for 15 years. Before that I was head of investment consulting of Russell Japan office. Our portfolio is try to be so unique, almost everything alternative. Frankly speaking, other than petty cash and some MRF type, MMRF or MMF type of equity cash equivalent portion. Other than that portion, all the investment alternatives. Mainly private equity, some private credit, and the hedge funds. And currently, the largest position is almost same private equity and hedge fund. And some real estate, distress, insurance-linked products, natural resources, blah, blah, blah. Such kind of many kind of alternatives we put in our portfolio right now.
Wai Leng?
Hi, I'm Wai Leng from CDPQ, Caisse dépôt. We are a pension fund manager from Quebec, Canada. With about US 330 billion of AUM. So, we being Canadian, we are, I would say, quite early into our journey in alternatives. So by today, what we call alternatives, e-liquids, private markets, is about 55% of our AUM. So that leaves us with 45% or so in the public markets, as well as fixed income. So most happy to share more later.
Great. And Julian?
Good morning, everyone. I'm Julian Soo from MAS's Reserve Management Department. I oversee our external fund management division. And prior to that, I oversee our asset allocation division. So for our portfolio, it's about 380 billion currently. Private markets is quite a small allocation compared to my fellow panelists as well as other investors out there. So roughly about 6 billion. We try to be as diversified as possible in our allocations. So a good mix of allocation across cash, bonds, equities, and commodities, as well as, I would say, across developed and emerging markets, and also in different currencies. I'm looking forward to the discussion today and happy to share what I can.
Great. Well, there's, like I said, plenty to talk about, but I think what's unique, we have different countries represented on stage, very different institutional mandates as well. Yoshi, could you start by just giving us a sense of what that looks like for your organization? I think that you tend to have a much higher allocation to external managers as well, so share that with the audience.
So portfolio construction of such type of, say, variety of alternatives are a little bit difficult one. Our approach is just to visit and meet the manager as much as possible directly and try to find a unique and niche strategy. Most important thing for us is risk, risk level is not so important. We focus on the more, say, Sharpe ratio or information ratio type of one. If that risk is a little bit high, but expected return is so high, so I'm very happy to accept the idea. And the important thing is the correlation with the current existing portfolio, and also that strategy unique and what is the differentiating point comparing with peers. So if we feel, okay, you are so unique and very different from others, and also match with our portfolio, so I and my team will discuss about the possibility of investment in your fund.
Great. And Wai Leng, CDPQ and Canadian pensions in general were really the trailblazers when it came to investing in a liquid fund and including that in their portfolio. Can you speak to how that represents the organization and how you think about that more broadly?
Sure. I think we started our journey, you're right, relatively early, moving into alternatives. And so if you look at what is interesting for us today, I know there are a lot of GPs out there today, but we do manage about 85% of our AUM internally. and only about 15% is managed externally. The way we look at our partnership with our GPs, it's really, we don't have boots on the ground in every single market that we invest in. We don't have the most localized knowledge. So that is when that 15% comes in. If the GP is able to add value either in the form of a differentiated strategy, local knowledge, local network, and that's where we tend to then gravitate towards using an external GP. And if not, then it's really managed in-house. Just to look at the APAC office, we already have presence in Singapore, being a regional hub. We have got local offices in India, and we have got local office in Australia. And that's really boots on the ground because we invest in real assets in these markets, and that includes infrastructure and real estate.
Great. And Julian, at MAS, I think you also have a very unique mandate for the organization. Can you share that?
Yeah, so as some of you might know, we are first a central bank, so the investment portfolio serves to support the conduct of our money, of our exchange rate-centered monetary policy. So liquidity and safety are very important for us. And so that sort of constrains what we can do in the private market space. I mean, we see value in having a small allocation there, both for developmental objectives as well as diversification benefits. I think there's certainly scope for us to do more, especially if our official foreign reserves grow further. But that said, I think our key strategy really is to make sure that we keep a very well-diversified portfolio so that it meets our liquidity needs, it meets our risk tolerance thresholds, as well as then we start to see where we can to do more developmentally, to do more to enhance returns, to do more to sort of bring in more diversified sources of return streams, because our portfolio, as you can imagine, is predominant in public market space, and sort of, if you will, the less correlated we have to some of the additional alpha strategies that we can bring on board, the more resilient we can make the portfolio. So I think that's the key plank of our strategy.
Thank you. Let's shift gears slightly and talk about fixed income. For the past 10 to 12 years, we've seen high returns because of rates, and we're starting to see a change and shift in that direction. How does that impact the portfolio and how you're thinking about your allocation? Wai Leng, would you like to start?
Sure. The impact of interest rate actually runs across both our public and private. So obviously on the private side, it impacts valuation. I think that's something that all of us are familiar with on a mark-to-market basis. And then on the public side, so in terms of how we look at fixed income, I'm most happy to share that we are actually doing a lot more than your traditional sovereign bonds. So we've actually ventured, to quite a large extent into what the banks would call structured finance. So including mezzanines, we do that. We do specific infrastructure debt. And that's really because we feel that we understand infrastructure equity fairly well. So, as a result of that, we do a fair bit of infrastructure debt. And lastly, we do a fair bit of private credit. But I guess this is really an area that has gained a lot of momentum in the market. So again, with the directions of the US interest rate, that clearly impacts our entire portfolio, whether it's on the public or the private side.
Yoshi, I see you nodding your head. Do you also look at infrastructure, private debt? Are there alternatives that you're considering?
Yeah. We've already invested those assets, right? And we started such kind of diversification of the debt side is 12 years ago. We started bank loan and some private credit. We started 12 years ago, and also infrastructure debt 10 years ago, and blah blah blah. Such kind of diversification in the fixed income side we've done so eagerly because we are Japanese corporate pension funds, and it's so unfortunate that Japan government bond and Japanese interest rate is so low. So we need more return, but from the domestic fixed income market, we cannot get such kind of attractive returns. So that's why we started to invest globally, especially in alternative yield, alternative fixed income type of investment so much. Now we not only saw that type of assets, but also CLO and also even the CLO equity we invested, and some litigation finance and trade finance, and so try to diversify as much as possible in the fixed income. But other than Japan, that was our past concept. So U.S. presidential election issues, so little bit we have to consider this strategy is right, or we have to modify our strategy. That is still our internal discussion, but we believe, okay, especially for the U.S. market, we can put some allocation on long-term high-grade fixed income product. So if we consider of the rate decreases in the midterm or in the short, little bit for the long run, okay, we can safely we can have long-term fixed income such as municipal bond or government bond, I don't know, but some kind of so high-grade corporate long-term bond. Maybe we have to add in a portfolio.
And I'm curious, just to dive into that a bit deeper, when you're thinking about the length of time for these opportunities, what's midterm mean to you?
Great. Excellent question. So our portfolio is, we mean short term is less than 5 years. Midterm is 5 to 10 years. We are very long-term investor. Long term is 10 to 15 years. And also we have a category with super long term. Super long term is more a change of the world, such as say natural resources, or say it's a growing market, but emerging one, frontier one, such as India infrastructure or Brazil, or such type of investment, super long term. 5, 10, 15 years, that is a threshold.
I like the idea of super long term.
Super long term, yeah.
Julian, how about yourself? Is there, thinking about time periods, of course, in your risk framework that you're operating within, how does that impact fixed income and how you're looking at rates?
So we try to see ourselves as long-term investors. So for us, typically it's 10 to 20 years. So some of the shorter-term gyrations, we try as best as possible to look past through the cycles. As you can imagine, predominantly a portfolio that has exposure to nominal bonds. So interest rate fluctuations will obviously affect our mark-to-market valuations quite a fair bit. We have sort of some allocation to public equities as well as private equities. So there's some sort of a natural automatic stabilizer, if you will. Well, as discount rates shift, it sort of provides a bit of a hedge against some of the interest rate impacts on our nominal bond exposure. So I would say we try to first and foremost build a very well diversified portfolio, look past through the cycles, we stress test our portfolio regularly, try to make sure that it's resilient across all these various scenarios, including interest rate movements. And I would like to think that obviously over the shorter term, over the medium term, 1 to 3 years, 3 to 5 years, we will get, we report our numbers annually. As a statutory board, we release our public annual statements, and you see fluctuations in our reported P&L. Internally, we view them in terms of, because we invest in foreign denominated assets, so we try to look past some of these publicly reported numbers which are in Singapore dollars, for example. So a lot of currency translation effects and so on. These are not germane to our investment decisions, but really a result of monetary policy. So for us, we look at a portfolio, diversify it across our foreign currency denominated asset classes, try to look past and stress test against these various scenarios, including interest rate ones.
I'm glad you brought up currency. I was going to ask Wai Leng to start. How do you think about currency within the portfolio, valuations, and also just the current market environment? Is that changing how you're perceiving that for the portfolio?
That's a very tough question to answer. So I would say that, again, coming back to the fact that because we're long-term investors, so maybe I think what I'm sharing is a little surprising, to the audience. We actually do not do active hedging of our portfolio. And one of the main reasons is because that our reporting currency is in Canadian dollars rather than US dollars. And so if you, particularly within Asia itself, you would see quite a fair bit of Asian currencies moving together with commodities. And no surprise, the Canadian currency is also moving alongside the commodity play. So as a result of that, our hedging strategy, is rather different. For example, with the US dollar denominated fund. So that is one. But clearly, that's something that we pay attention to. But I think, again, coming back to, a lot of the Asian currencies, it's actually, very expensive to be hedging, beyond, if you can get liquidity. It is still expensive to be hedging beyond 3 years. So as a result of that, that is something that we looked at, we analyzed it, and we actually build it into our base case to the extent possible.
That makes a lot of sense. Julian, would you like to jump in here?
I think similar views. So when we construct our SAA, for example, we take the currency implied mix. We iterate the process, obviously, and we make sure that are we happy with the currency mix that's implied by our asset allocation, for example. If we don't like it, we go back and re-optimize it, for example. One of the scenarios that we stress test this mix against is more of like a currency scenario, if you will. Our emerging market exposures, quite difficult to hedge the currency exposures there effectively. And as earlier mentioned, our reporting currency is in Singapore dollars just for statutory reasons. But realistically, when we construct our portfolio, we manage our portfolio and we manage the risks, we look at it more from a local currency perspective, if you will. We're happy to derive the asset returns implied in the local currency terms. And we think over the long term, it sort of washes out. Interest rate differential, inflation rate differentials, you sort of get compensated, if you will, over the very, very long term. Obviously, over the shorter term, you get various fluctuations that I think we're happy to ride through. And as long as it meets our liquidity needs, it's within our risk appetite, I think we're happy to go along with that.
Yoshi, in Japan, your portfolio has a large number of external managers as well, but how do you think about currency and valuation?
It's so very hard issue to currency management. But we decided our policy of the base, how can I say, policy currency allocation. So we invested almost everything outside of Japan other than cash. So our portfolio is mainly US dollar, the euro, and blah, 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 some kind of other currencies. But after hedge back to Japanese, then, okay, we keep 80% Japan currency and 20%, now it's 24%, 25%. So it's 10% US dollar, 5% euro, 5% other emerging country, and 5% focus on the, say, how can I say, natural resources related to countries such as Australia and, say, gold. We believe gold is one currency. So such kind of, say, only 25% is currency outside of Japan, and 75% in hedging back to Japanese yen. And that kind of passive portfolio we keep every month. But so recently, it's currency hedging cost is so high, especially for US dollar terms, 4.5% hedging cost annual we have to pay. In that sense, if we would like to hire appropriate US dollar denominated hedge fund, okay, at least we believe 11 or 12 years annual returns we require. Because our past performance for 5 years, 10 years, 5 years is almost 8%. It's annual, our return. That is hedging back to Japanese 8% means US dollar terms 12% is required. Such kind of manager we'd like to find.
No, I think that's a nice segue of thinking about the evaluation of internal management, external management, sourcing managers. Why don't we start with the firm that has the least in terms of external managers, perhaps? But at CDPQ, for those, how do you think about the balance of internal and external managers in terms of manager sourcing and assessing your portfolio?
Well, I think there's never a static number, I would say, because obviously, business environment changes. Our business model, will also be evolving over time. So, while I say 85-15, but that ratio could obviously change, depending on the market, but it's just not going to happen overnight. I think it could be a gradual process. And I think more importantly, the recognition is that external managers do bring value to us, because again, I think part of the review that we do on a regular basis is kind of, what I call an internal soul searching to a certain extent. What is it that we do well internally? What is it that we do that it's, maybe at best marginal, that we should really think about what do we do with that? And lastly, what are some of the new areas that we would like to be involved in, but we are only starting to build up, internal knowledge and expertise. So I think that kind of determines the mix of internally managed portfolio versus externally managed.
Can you share some examples of where perhaps you feel you aren't as strong internally and in some of those new areas as well that you're looking at?
I think one very good example, is, for example, blended finance. So blended finance, clearly, it's a topic that I think a lot of players in the market, we recognize the importance of financing, for example, energy transition, adaptation, and those are not easy conversations. So I think it is only with blended finance that with public-private family foundations, developmental agencies, that you're able to come in, to potentially do a blended finance solution. So one good example is the RAM project that we did. It is in our home, our home market, Montreal. But still, that is something that we're fairly proud of, because it's really the first rail network within Canada over the last 50 years. And that would not have been possible had it not been a blend of public, private, as well as the fact that, the end users, the society at large, are happy with the outcome. So, plus, obviously, it is good for, the carbon emissions and all, because you're replacing private with public transportation. So that is something that we look forward to doing more. It is clearly something that CDPQ alone will not be able to do.
Right, that's a great example. Julian, how do you think about, again, the balance between sourcing and evaluating external managers given the bounds of what you're looking at MAS?
Yeah, so as some of you might know, the MAS is both a central bank, so reserve manager, as well as a developer of the Singapore Financial Centre. So our external fund management program really exists sort of fulfill both of these functions. So we have both developmental objectives as well as trying to enhance the returns of our portfolio, as well as bring in some, if you will, knowledge transfer for areas that we are lacking internally. So for us, we sort of calibrate it accordingly. It's sort of fluid. I mean, we have quite a fair bit invested in with external managers, especially for new strategies that we try to introduce. For example, the Green Investment Program. The Private Markets Program, obviously, we tap on external fund managers. I guess, if you will, resources and also the ability for us to scale up internally, and the timeliness for doing so. So we sort of balance between both before deciding whether to tap on external managers or to leverage internal ones. And also traditionally, given our central banking background, what we found is our in-house managers tend to be better at, I guess, what you call macro analysis, fixed income, as well as FX markets. So frankly speaking, a lot of the credits, a lot of our equities expertise, a lot of our green strategies, private market expertise, we really have to rely very much on our external managers.
That makes sense, definitely. Can we speak a bit about active versus passive management as well? How do you think about that with funds when you're evaluating the different managers that you see?
Yeah, so we try to make sure that our overall portfolio is actively managed for a very simple reason that we think we're sort of like leaving money on the table if we don't try to have it actively managed. We construct our portfolio to try and take in, if you would call beta returns, but thereafter we want to make sure that we allocate enough risks to all our managers, both internal and external, to try and, I guess if you will, push the needle a little bit, try to enhance returns as much as possible. I think the challenge for us really is across different asset classes, I think. You find manager performance varies quite a fair bit across different types of strategies, across different types of styles, if you will, different sorts of processes. So what we try to do is really focus very much on trying to find out what the secret sauce of those managers are. I mean, it's quite a challenging task, but we try our best. So within the managers that we are trying to anchor developmentally in Singapore, we try to suss out the best strategies that we can find. And thereafter, work with them also on knowledge transfer to try and see how we can imbue some of those in our internal management processes and then take it from there. So overall, I would say it's quite a holistic assessment. Sometimes we get it right, sometimes we get it wrong. And if we do, we sort of try and cut losses and adjust and recalibrate again. But overall, so far, I would say so good.
I'm curious to hear in a moment Yoshi's view on the secret sauce as well. But before we do that, just curious as well, how long do you typically keep a fund in your portfolio before there tends to be that natural turnover?
Yeah, it typically varies. The starting point really is for how long some of these developmental commitments are made for. It could be a year, it could be 3 years, so it really depends. And I think importantly, it also matters to us the performance within the broader environment. So on a relative basis, or from a benchmarking perspective, how do they perform to, say, the other managers out there within the comparable universe? So no fixed answer. We obviously monitor and reassess them very regularly, especially for those that we have just more recently funded, and where we haven't built up the rapport and the confidence with the managers per se. But it tends to be fluids. If you recall, I did say that we try to see ourselves as long-term investors first and foremost. So we try to avoid chopping and changing the portfolio as much as possible if we can. But again, if push comes to shove, it doesn't stop us from cutting our losses quickly. Yeah.
That makes sense. Yoshi, what do you look for in terms of your external managers, particularly in the new market environment that we're seeing ahead?
Okay. So in Japan, we have two separate regulations. We are pure corporate pension fund side. Corporate pension fund cannot have internal management function. No, that is prohibited. We always find the appropriate commingled funds with external managers. And the public pension fund side is totally different. Public pension is in Japan so big names. GPIF is $2 trillion AUM, and say public officers half trillion. Yeah, and another say regional officers $500 billion. Campo, it's postal life and postal savings and postal pension, and another half trillion. Such kind of big entity can have internal management. That is regulation. From our side, just find appropriate external managers. That is our job.
Well, in the final minutes that we have here, the search for growth continues to be increasingly challenging. Are there any areas where you're seeing signs of success looking ahead, or maybe on the flip side, areas you're looking to really avoid? Wai Leng, you could start.
Yeah, I'm trying to think. Again, I think we always come back to the fact that we're looking for risk-adjusted returns. So I think in terms of growth, again, if you look at the sectors, I think every one of us out here, are kind of looking at the same growth sectors. So whether it is in the area of renewables, in technology, as well as obviously the economic macro play in the Asia Pacific region. So I guess these are the usual suspects when it comes to growth drivers. So again, for us, it always comes back to kind of a total portfolio construction, is what Julian was saying, and how do we build a more resilient outcome.
That makes sense. Julian, any sectors you're looking to avoid?
No, I'll echo what Wai Leng was sharing. So yeah, sustainability remains important for us, notwithstanding the recent headwinds. Technology as well, how it impacts on the long-term outlook. I think it's a bit early. We're not quite sure whether it flexes both ways. It could enhance productivity, could lead to job losses. I mean, we're still taking a wait-and-see approach, but something that we're watching very closely. And sustainability is just, we have started to take actions in our portfolio, but it's such a long process. There's so much uncertainty. So it's quite difficult to make too much judgmental calls on the pathways, the outcomes. So what we have tried to do is at least try to start small and gradually scale up as real-world progress is made in terms of the transition.
Great. Well, exciting times ahead, certainly with the long-term horizon as well. Thank you all for being here, and everyone else enjoy the event.